Hi, and welcome to the end of February update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with the current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of the book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we will review our system, starting with a safety belt system. Then we'll add on the momentum rotation system. Then we'll review the free SectorSurfer strategy that comes with any SectorSurfer subscription. Then we'll remind ourselves of the rules for the stock tip strategy, and then we'll wrap up. So let's get started. So when we review our systems, the first system we'll review are the stock market safety belt systems. So the one I described in my book is the 20-month simple moving average system. It's a great way to introduce those of you who are not familiar with safety belt systems in general. All we're doing is using a formula to try to differentiate when it's relatively safe or dangerous to be in the stock market. So, for instance, the one I described in my book is called the 20-month simple moving average system, otherwise called the 20 SMA system. Now remember, these safety belt systems do not guarantee against all losses. However, if we can at least decrease losses from a major stock market bear market and increase our chances of survival, then that by itself can be a great improvement. So for the safety belt system that I described in my book, the 20-month moving average system, if the price of the S&P 500 Index mutual fund is above the 20-month moving average, it's relatively safe to stay invested in the fund, otherwise get out. Remember, these systems only work if we watch it every month. Not more often, not less often. So here's a graphical representation of the concept. If the blue line is the S&P 500 Index mutual fund, dividend corrected, and the red line is a 20-month moving average, you can see how when the blue line is above the red line is relatively safe to be in the market because it tends to wiggle, but at least the wiggles never really turn into a big bear market. But once it crosses below the red line, it tends to keep on going down for months to years, until finally the market goes above the red line again, then it's relatively safe to be in the stock market again, and so on. So right now, we see that back in December, we had a crossover below the line, and then January we crossed above the line again, and now it's still above the line. The closing price of the Vanguard S&P 500 Index is $257.96 per share, and the moving average is at $244.91. So you do some basic math, you get a 5.3% cushion. In other words, right now, the S&P 500 Index mutual fund can go up, stay the same, or fall up to 5.3% by next month, and we'll still be in the safety zone. However, if by next month the fund goes below that red line, then that's a signal to get out. So right now, according to this safety belt, we're relatively safe to be in the stock market. And of course, here's SectorSurfer's StormGuard Armor safety belt. So StormGuard Armor, again, we're trading between the same stock and bond mutual fund. And you can see for this month, we've been in the stock mutual fund and we're still there. So according to this system, it's still relatively safe to be in the stock market. And here's a graphical representation of the StormGuard Armor indicator. So right now, you can see it's barely above the zero line, which technically means, yes, it's still relatively safe. We will be watching this every month to make sure it doesn't fall below, because when it does, we're ready to get out of stocks and into our safety fund, in this case, the long-term treasury bond fund. So our next system will add the momentum rotation systems. The reason why I say add is because I no longer do just momentum rotation system. In fact, the system I described in my book called the MRI system, for the monthly rotation investment system, I no longer follow. In fact, even when I use the same three sector mutual funds, the S&P 500 Index Mutual Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund, using SectorSurfer's version of rotation, although better than buy, hold, and pray, still has weaknesses that are balanced out with the safety belts. So I no longer follow even the SectorSurfer version of the MRI because rotation works best, in this case, with a safety belt system. So what do I mean by rotation? So an example of just sector rotation is if we were to use broad market sector funds, in other words, large cap, mid cap, small cap stock funds, US stock funds, real estate stock funds, international and emerging market stock, and long-term treasury bond fund, and then every month just determine which of these 7 funds did the best and just held on to that one fund until either that fund weakens or another fund does better, we would exchange these funds approximately 4 times per year, and we would get this yellow curve, at least on retrospect. For comparison, the white line is the S&P 500 index, and these other various colored lines are corresponding to the other funds that we described. So yes, we can improve our overall performance compared to our various individual components. However, if we were to separate out the stock from the bond funds and use a seatbelt strategy so that when it's safe to be in stocks, we rotate only through the stock funds, and when it's dangerous to be in stocks, we go into the long-term treasury bond fund, then we would get closer to something like this yellow line, where now we're only trading maybe half as much, 2 times a year, and the returns are smoother and less volatile. So that's how we combine the 2 systems in SectorSurfer. Of course, when you subscribe to SectorSurfer, you can get a free strategy through SectorSurfer. They're usually not as good as something that you can build yourself because there are a few nuances that if you just put into your strategy, you can improve. However, let's take a look at this free strategy. The free strategies in general use generic asset class funds. They use an older version of StormGuard, and they do not separate out stocks from non-stock funds for rotation purposes. So here's an example of a free SectorSurfer strategy called My ETF Asset Class. It uses an older version of StormGuard, the StormGuard Acute Quick Response. It goes into cash when it's relatively dangerous to be in the stock market. However, it does use stock mutual funds for when it's relatively safe to be in the stock market. By using this free strategy, you only trade 3 times a year, and you're getting this yellow line, which, at least on backtesting, returns approximately 15% per year for the last 24 years. Now, if that's good enough for you, then SectorSurfer you can use for free using this strategy. And if you are using this strategy, then be careful because this month there's a trade alert. So when you get a trade alert, you get a text message, you'll get email, depending on how you set it up, or both, saying, hey, there's a trade you have to make. And when you log into SectorSurfer, you go to My ETF Asset Class or whichever strategy you have, where you see this red Acknowledge Trade button with instructions to sell this, buy this, and the date that this trade was generated. So what you do is you go to your brokerage and you physically produce that trade. Once you make that trade in your account, you come back to SectorSurfer, click on the Acknowledge Trade button, and it turns into a green Done button with a check mark, and SectorSurfer will stop bothering you until the next signal. So the next system we'll explore is the stock tip strategy. The stock tip strategy rules, this is only if you absolutely positively have to buy a certain individual stock for some strange reason. I do not recommend it, but if you do, at least have some kind of strategy. Here's one strategy you might be able to use. So consider that you never want to risk more than 1% of your portfolio or trading account on any one stock. If you take a look at professional investors and traders, they never risk more than 1% unless they're heavily day trading, then they don't risk more than 2%. It's the amateurs that risk 25%, 50, 100% on any one stock which get killed and crashed. So do what the pros do. Risk only 1% of your portfolio in any one stock. If you do that, and if you have a 25% trailing stop loss order, you can use 4% of your account to buy that one stock. This way, when it falls up to 25%, you'll get out and you only suffer a 1% loss. Now, if the stock goes up 33%, now it's safe enough to buy another block of stock using another 4% of your account. Because now your sell is essentially at break even, where you bought the stock previously. And remember, when you buy more stock, you adjust your trailing stop loss order to reflect the increased number of shares, and you just keep doing this until you're finally stopped out. So in summary, we reviewed our systems for this month. We started with the safety belt system, added on the momentum rotation system. We examined our free SectorSurfer strategy, in which case there was a trade alert this month. So remember, some systems have trade alerts this month, others don't. When you're subscribed to SectorSurfer, I don't know your SectorSurfer strategy. You must take responsibility to make sure that you didn't miss any trade signals. I log in at least once a week just to make sure I don't miss anything. And then, of course, we review our stock tip strategy. So keep those questions coming. I know I talk to several of you personally each month, and I realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session for you, just you and me. Ask all the questions you want, no matter how seemingly basic or close you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, the reasons why you're investing to begin with and how to get you there, discuss investing building blocks that are more specific to your situation, determine what has stopped you in the past from getting what you want now, identify what are the most important steps you need to take now to get to your investment and financial goals, and then complete our consultation with excitement of knowing what to do next. Think CME, only this is financial, and think Checkup, because if you had a financial cancer or blind spot, wouldn't you rather know sooner rather than later before it grows and metastasizes? Don't be bashful of reaching out. The more you delay, the more time is against you. So, until next month, invest safely.